global unrest and a sluggish economy aren't stunting the growth of the real estate market, we'll visit an industry insider to explain. Plus, holiday shopping this year will be driven by two up-and-coming demographic cohorts. We'll talk with a millennial about her generation's plans this holiday season. This is 7 Day Yield.
Welcome to 7 Day Yield. I'm Lydia Morrish.
And I'm Mitch Roschelle, and here's what's trending. Austin, a city of just over 2 million people, is ranked number 1 of 78 cities. That's according to Emerging Trends in Real Estate. The list, recently released by PwC and the Urban Land Institute, ranks cities for their real estate investment potential for 2017. Austin's large and rapidly growing millennial population are among the reasons investors are bullish on Texas's capital.
Deal activity in the third quarter of 2016 seems to be driven by the opportunity to disrupt or avoid disruption. Technology-driven deal momentum continued to build with a large concentration of multi-billion-dollar mega deals. Traditional non-digital businesses picked up 116 technology companies for over $31.4 billion during the quarter. PwC expects demand for cloud, artificial intelligence, and machine learning technologies to contribute to future deal making.
While millennials may be key to real estate, Gen Z, 86 million kids strong, is a growing component of the retail consumer market. Born in the digital age, 90% of these youngest shoppers are highly motivated by influencers such as celebrities. Social media is the key tool to connect Gen Z to their favorite product spokespeople. Global instability and slow economic growth hasn't shifted investor focus away from real estate. In fact, more than 80% of investors surveyed, according to Emerging Trends in Real Estate, believe that the prospects for 2017 are strong. I recently appeared as a guest on the Commercial Real Estate Show and decided to flip the script and ask Michael Bull, the show's host, some questions this time. Roll tape. So there's a special interview for 7 Day Yield. I'm actually on the set of the Commercial Real Estate Show with its host, Michael Bull, who's the CEO of Bull Realty. And since I was here today having Michael interview me, I decided I'd turn the camera on him for a change and interview Michael for 7 Day Yield. So Michael, thanks for coming on 7 Day Yield.
Hey, it's going to be easier, right? I'm just answering the questions.
You're just answering the questions. Michael, as an advisor to investors, owners, operators, tenants in the real estate world, what's the mood right now in commercial real estate?
Well, I think there's so much change in technology that I think some of the mood is just being flexible with your investment criteria. If you're an investor and maybe you're looking at a second-tier city, or maybe you're looking at value add, depending on your risk and return. And I think for the businesses that we represent, it's all about being flexible and understanding what's going to happen down the road is going to change, and being ready for it.
So you interview hundreds of people as the host of the Commercial Real Estate Show. Have you seen over the last, say, 18 months, as we've gotten deeper into the cycle, we're now about 90 months into the economic cycle, have you seen anxiety start to build in terms of when this is going to end?
I've seen some of that, but I think I've been more surprised by lack of anxiety. It's like, all right, our memories are short, right? This is just going to last forever. And it seems like that's what surprises me more, that people think, well, we're going to be in these very low interest rates forever, and the market's going to continue to improve slowly forever. So I think it's almost surprising me, at least from real estate investors and sellers, that they have no anxiety. Now, I think business owners are a little more apprehensive.
When you say business owner, you're talking about a tenant.
Yes.
Right, being a tenant and not wanting to bite off more than they can chew.
Right. It's like, look, no, I don't want 8,120 square feet. I want 8,100. I don't want to pay for that extra 20 square feet.
It's gotten that granular.
It seems that it has at times. Business leaders are just a little nervous about what's going to happen, down the road.
Isn't that a healthy thing, though, if you think about it? We've lived through, I don't want to say how old we both are, but we've lived through 4, maybe 5 economic cycles in our professional life. Isn't it healthy that CEOs, business leaders are holding back a little bit and not jumping in, preventing us from getting ahead of ourselves? Is that a good thing or a bad thing?
Well, I think it's a good thing for the most part, that business leaders are understanding their growth and being safe in their investments and their growth of their companies. But I think it's sometimes you got to take the plunge if you're going to be successful. And I think investors are the same way in commercial real estate.
But when I think about it, the foreign investors have played a big role. Have you seen a change in foreign capital in the U.S., in Atlanta or other cities of late?
Yeah, I think we've seen an increase in foreign capital, and I think more so because Atlanta is kind of considered a secondary market, and a lot of the markets we work between are considered kind of flyover secondary cities, and I think we're starting to see even more foreign investors investing in deals in these types of markets.
Because we're in an election cycle, no names, no picking sides here. We're apolitical on 7-day yield, but it's really put taxes back in the debate. Have you seen that start to change the mood of people in the real estate space?
I don't think people think that one side's going to get in there and be able to make material changes, with the tax laws. I don't see the investors that we deal with having a concern about that.
Excellent. Michael, thanks for coming on our show, 7-Day Yield.
Thanks. Glad to be here. Thank you.
So Mitch, you referenced emerging trends in your interview with Michael. I believe it's in its 38th year.
38 years.
Could you tell the audience a little bit about the publication?
Great question, Olivia. So we've been doing it in partnership with the Urban Land Institute, and there's 3 pieces to it. We survey 1,000 real estate professionals and get their feedback. So like at the top of the show, I talked about Austin being number 1. That comes from a survey process. Plus we interview 500 people. So that's totally exhausting. Bags under my eyes. The makeup's covering the bags underneath my eyes. And then we grab a lot of third-party data because we try to take those 2 pieces, the interviews, the survey responses, and kind of make sense of them with data.
Mm-hmm. So obviously this year was a little unusual leading up to the election. Your survey respondents, did they express any anxiety about how real estate would be impacted by the outcome of the election?
I would have expected it, quite honestly. I would have expected, with all of the headlines, you can't avoid election headlines. Now, just so everybody knows, we do a lot of the survey work and the interviews towards the end of the summer into the fall, but still that was consuming every 24-hour news cycle. A couple things about real estate. One is the more instability there is in the world, the more people fly to safety, and real estate's that safety bet around the world, also in the United States. Number one. Number two, it's really an interesting thing, talk about 38 years. We went back and looked at about 4 decades worth of red states, blue states, Republicans, Democrats, to see if there's any correlation between the way real estate performed from a valuation perspective, from a cash flow perspective, and who was in office. Nothing. There's no real correlation. So I think that what that says is it kind of, from a real estate investment perspective, it doesn't matter. What's interesting about real estate is most of the cash flow is subject to a long-term lease. So that long-term lease could be longer than any politicians in office. So I guess real estate investors are agnostic at the end of the day.
Which could be a good thing for a lot of viewers, depending on which side of the aisle you fall on.
Exactly.
Great. Thank you so much, Mitch.
Just cool, I get to be a guest, by the way.
After the break, we're speaking live with Allison Stone about millennials and their holiday shopping habits. Stay with us.
I'm totally getting these new headphones. Ooh, I love those headphones.
Did you see what Emma just posted about next year's line?
Yep, doing in-store pickup on that.
No way. I'm going with.
Millennials represent 30% of the U.S. population, and not surprisingly, they are a force to be reckoned with in the retail market. Allison Stone is the self-described Chief Millennial Officer of PwC's retail practice, and she joins us live in Studio C. Welcome,
Hi.
Allison.
Thank you.
That's not a real title, but we've sort of have fun with it. Chief Millennial Officer. So speaking of millennials, let's talk a little bit about them and shopping, and why are they really a force to be reckoned with?
Yeah, so millennials and Gen Z are 2 of the largest generations now. So it's really important to understand their shopping behaviors if you're a retailer in order to steer your store or your online website to these generations. So they have very different shopping habits from the older generations.
I have twins that are Gen Z, so I get their shopping habits. But the millennials sort of span a pretty long age group. There's about almost 20 years worth of difference between the youngest and the oldest. How are they behaving differently from a shopping perspective?
So millennials are looking for experiential gifts. So it's even different from Gen Z, the younger consumers. They're looking to be able to share these experiences on social media. You know, they don't want just a traditional gift where they receive it and they can't tell all their friends about it. They really want to be able to post it, and they also are following influencers to see what types of gifts or experiences they can look for. And Gen Z, unlike millennials, are looking for these traditional gifts. So more personal electronics, mobile, tablets, even toys that are controlled via their mobile phones. Yep, drones.
They don't get outlawed. I was reading an interesting statistic about Gen Z that they're more influenced by product reviews by other users as opposed to by traditional ads. So what's sort of the implication here for the actual retailers?
They grew up in this era of social media, so they're scrolling through their different social media sites looking to see what's hot, and what they're really looking for are what influencers are promoting. So 90% told us that they relate to influencers on a personal level.
So who's an influencer, like a celebrity?
Yeah, it could be a celebrity, a public figure, an athlete. Really, when we talked to them, it was a wide range of different types of people. But they made sure to tell us that they had to be authentic. So if they weren't authentic and they could see that these influencers were being paid or just posting things they don't truly believe in that didn't align with their core values, they didn't look at what they were posting as much.
I saw something interesting in the very lofty PwC Holiday Outlook, which I love and you contribute to. That there's a difference between giving and receiving, right? So 52% of people feel one way about what they get and 27% feel differently about what they receive. So there's a big gap between people who want to give versus want to receive as it relates to gifts, okay? I mean, a traditional gift. Why is that? And do people just have bad taste? And because gift cards seem to be the big difference, that people rather receive a gift card than your bad taste than what my gift is. Is that really what the bottom line is?
Yeah, so a lot of people were looking to receive gift cards. They wanted to be able to pick out their own gift, and maybe they didn't like what they were receiving from other people. However, even though that's what they wanted to receive, they didn't necessarily want to give gift cards, so maybe it seemed impersonal, whatever the reason might be. But yeah, there was a very big difference between that.
I was totally fascinated.
Yeah.
So I'm going to leave you with one question, which is, and we talked about this on a previous episode, I think it's a 10% increase year over year in terms of what we're expecting in holiday sales. But it was interesting, there was a cohort of $50,000 of household income or less was actually going to be spending more proportionately than, and why is that? That was just an aha moment. I didn't expect that to be the case.
Yeah, so I think the exact statistic was households with less than $50,000 of income were going to be spending 23% more this year, and households with more than $50,000 were going to only spend 4% more this year. So there's a big difference. The households with less than $50,000 have more disposable income this year. They have about $1,400 more disposable income due to decreases in gas prices, electricity, and prices of food. It was partially offset by increases in healthcare costs, but they have more disposable income and they're optimistic, so we'll see what happens.
We'll see what's happening. Well, this will air around the holidays, so happy holidays,
Happy
Allison.
holidays.
Well, thanks for joining us. On our next episode, we'll be talking about marketplace lending, and we have industry insiders and actually one of the pioneers of crowdfunding. You're not going to want to miss that one.
Thanks for watching. To catch up on previous episodes, be sure to check out our PwC YouTube page. Plus, you can follow us on the Twitter handle below. We'll see you next time on 7 Day Yield.